We're so excited to have Jonathan Twombly on the show. Jonathan, thanks so much for coming on the Tech Guys Who Invest.
Hey, thanks so much for having me on the show, guys.
Yeah, absolutely. We're really glad you're here. So, Jonathan, you went from being a lawyer in New York City to multifamily investor. Can you tell us about your journey from lawyer in New York City to multifamily investor?
Gosh, yes, it was kind of a long and winding road, but I was practicing law here in the city. I worked at a number of big firms, and was doing commercial litigation related to real estate. So I was litigating a lot of real estate related stuff, particularly litigation between hotel owners and the hotel chains that you're familiar with. And I wasn't particularly happy with that. The lifestyle was really a grind, and you just had the clients beck and call all the time, and I never saw my family, and I just was really ground down by it. So I wanted to be like more in control of my life, and also wanted to be calling the shots too. I was really tired of just being reactive to other people's needs. I really wanted to go and do something where I was creating something. And I thought for quite a bit about, trying to transition into maybe equities investment. I thought about for a while. I thought about also real estate, like going to work for a real estate firm for a while. But a bunch of things sort of happened at once. One was the great financial crisis of 2007, 2008, where I was just at that point felt, okay, well, I don't really like this job, but it's a good time to have a job, and it's hard to find a job. So, I'll just stick this out. And at the same time, when I was out there sort of doing some informal networking with people about trying to break into with some kind of investment career, I kept on getting the same uh, response from people, which was, hey, you have a spectacular resume and background, but right now there are 10,000 guys out on the street with 10 years of experience doing this thing, and they're going to get hired long before you get hired as a career changer into this field. And specifically when it came to real estate, uh, the New York real estate world it's a huge city, but it's a very small kind of real estate community that's controlled by a few firms, by and large. Uh, and, I was told, like, hey, look, it's going to be extremely difficult for you to break into this business. You, Really, the only thing I see happening for you is if you get lucky and somebody decides they want to bring you in, like as a partner in some kind of small firm or some startup venture. And right, so 2011, within a few weeks of each other, I learned that I was going to lose my job because I'd been sitting around for a couple of years at work with very little to do after the recession. Uh, and I was completely burned out, had no interest in trying to find another job. And then I met somebody who was starting up a real estate investment business, and she asked me to join her. And then I started talking to several of my friends about whether I should do this. And they said, well, if you do it, we'll invest with you. So I kind of like lost my job, decided to make a change, had the change sort of appear in front of me all within a couple of months' time of each other. So I decided that, I just sort of ran out my severance period, and just started up with this partner and this promise of investor money from these friends that I had. So this is 2012, 2011. We jumped into this. We kind of banged our heads against the wall for a couple of years looking at deals in Louisiana and Texas. We had a couple under contract that we got very close to closing, but unlike today, the lending environment back in those days, you guys have to kind of cast your minds back to 13, 14 years ago, but I guess it wasn't that long ago, so 2012, so 8 years ago. It was not the situation that we found ourselves in up until recently, where lenders were just throwing money at everything that, kind of sort of looked like they might get their money back. Lenders were looking at great deals and just, crossing them off the list for really, for frivolous reasons and no reasons at all. And we had lenders pull out of one of those deals at the last minute for really kind of really pretextual reasons. It was clear they had just decided that they just weren't going to do the deal for whatever reason, and they made up some reason to justify it. And then, out of our inexperience, we got skittish on the second deal and pulled out ourselves. We managed to get all of our earnest money back, but we were out of pocket all of the costs and expenses. And it was a really difficult, after working on this for 18 months and coming to that point, it was kind of a heartbreaking experience. Not to mention that, I was living out of savings during the time, so it was tough to lose money on top of that, not get the payday I was anticipating. So, but when all that happened and it was all said and done, my partner and I decided that we would go our separate ways. And so this is now end of 2012, I was having dinner with one of my friends who was going to invest with me. And I said, look, I don't know, really not sure what I'm going to do now. I might have to go back to practicing law. And he said, don't be so hasty. Why don't you and I, partner up, and I'll just be silent and, back the business and you run the business. And so that was how my company, Two Bridges, came into being. And finally, after I'd say 10 months of starting Two Bridges, we finally got a deal under contract in South Carolina and closed that deal. And then, we were kind of off to the races after that.
Wow. Thank you for sharing that. There was a lot there. There's a right place, right time. There's the fear of, am I going to be able to do this? And you still moved through that fear. What were you talking to yourself about? Like what were you, the self-talk when you were thinking of, should I continue to do this or should I not?
I guess, sometimes it's easier to overcome fear when you have like something even more scary chasing you from behind.
Mm-hmm.
And for me, that was the prospect of having to go be a lawyer again. So I was so unhappy being a lawyer that even when I was started out in real estate and I wasn't making any money and I was kind of stressed out about it, it was a different kind of stress. Like it was the stress of like, will I succeed or will I fail? It wasn't the stress of like, am I going to get home tonight, before 11, like just like the last 10 days in a row, like when
Right.
is my next day off going to be, like that. It wasn't that kind of stress. So that stress of like sink or swim was a better stress than the just miserable, I hate my life stress. So, and it was much, I was actually just much happier, even though I wasn't making any money. And it sounds bizarre, but I mean, going from like, $300,000 a year to zero and being happier, like just shows you how miserable I was as a lawyer. But yeah, that was what kind of kept me going. Just the belief that I could do it, and the fear of, not the fear of failure, but the fear of what would happen if I didn't succeed. Not losing money, but like possibly having to go back to be a lawyer again.
The alternative of not succeeding. Yeah, that makes sense.
Right. Yeah, it does. It makes sense. And what struck me in your story there was how different the environments or the climates or whatever you want to call it were then as compared to today. I haven't been in it long enough to have been through multiple cycles and be able to know for sure. But my understanding is they're just different things that are difficult. You're always going to have those challenges and those difficulties. Right now, one of them might be finding deals because so much is overpriced. But money is really easy to get. Back then, it was different.
It's really the opposite. It just, the different points in the cycle, and there's really maybe, a brief like 3 months of magic time where these things are in balance. But, basically your struggle is either finding the money or finding the deals.
Right.
And when you're at the bottom of the cycle, there are lots of deals out there. But it's difficult to convince people to part with the money. And at the opposite happens at the top of the market, where money is everywhere, but the deals are hard to find because the money is everywhere, right? So you're right. It's sort of pick your poison. If I had to pick between the two, I'd frankly rather be in the down part of the cycle than the up part of the cycle. There's a little bit of like luxury in saying that. Now it would be easy for me to raise the money and get the debt. With the experience I have, it was tough starting out at the bottom of the cycle, where a lot of people had just been burned really badly, and they were very wary about handing out money to people. But I think the bottom of the cycle is a great time to be an experienced investor or an experienced syndicator, because you have the track record built, and it's much easier to access the capital.
Nice. So when we were talking earlier, you mentioned the different markets. You said Texas, Kentucky, South Carolina. Those are the three states that I remember. While at
Texas,
the time,
Texas and Louisiana.
Louisiana, excuse me.
Yeah.
Those markets have changed since 2012, but I feel like the foundation of what you were looking for that said it was a good market won't really change regardless of where we are in the cycle. What would those things look like?
Well, I mean, to be honest with you, we started out in Louisiana and Texas because that's where my partner and her husband already owned some property. So she was familiar with those markets. I was a little bit skeptical of both of them, but for different reasons. I was skeptical of Texas because it was already very hot, even in 2012. And by nature, I'm kind of a contrarian. So if everybody is going somewhere, my reaction is, I don't know about that, right? So I was a little bit wary of Texas. Of course, like looking back on things, it probably could have bought anything there and made money given what happened. We could sell junk deals to people at premium prices now in Texas.
Right.
So obviously, we would have been fine buying there. Louisiana has all kinds of other issues with it. And, like it's one of the states in the South, it's actually not growing. It's historically, it's not common law. It's historically very corrupt. I mean, there's all kinds of like issues with Louisiana, which is actually why the bank backed out on us in those deals we had in Louisiana. Now in this lending environment, obviously you can get money anywhere for anything, no matter what it is. But I didn't really do any kind of analysis with those states. It was just where my partner already was, and I was just sort of along for the ride at that point.
Got you.
South Carolina was a different story, because that was where the market I kind of picked myself based on analytics, and that hasn't changed. And the reason I was looking at South Carolina, or really the Southeast in particular, was because I really liked the demographic story there. And I was very fortunate in that when I was getting started, the 2010 census data had just came out in 2012. So it was all like the freshest, newest data you could get. There was a ton of it, lots of stuff to go through. And basically I just started sorting all the MSAs by growth rates and proximity to New York. And I realized that, the Southeast was growing really, really fast. And it was very easy to get to from here, much easier than Texas.
Right.
And so that kind of just made it stand out. And I realized, like, I don't have to be in the hottest market in the country. I can be in a market that has really, really good demographics that nobody was really paying attention to at the time. Now, obviously, since then, the Carolinas have garnered a lot of attention. But at the time, again, everybody being sort of distracted by Texas, South Carolina was a great place to invest because it was just under the radar. But it had amazing demographics. So, I still look at the same stuff. I mean, I look at, as a baseline, I want to see growth, and as a way of, and most markets in the country are growing, right? Even the Northeast is just growing slowly. But most markets are growing in the U.S. But I would definitely eliminate any market that had zero growth or negative growth. But then there's a further way of, picking, well, if you can choose to invest anywhere, where you're going to go. I'd rather go to some place that's growing faster than the national average than slower than the national average, because all things being equal, more people moving in more quickly means more demand for apartments and less ability for the supply to catch up. So that was kind of like my fundamental cutoff point, was like what's growing and what's close to me.
And when you say growth, it sounds like it's more population growth, but
Yeah.
is that it, or is there something else besides that?
It's really, I mean, the basic assumption is population growth,
Sure.
right? Um, Obviously, you want to look at a diversified economy. I don't like places that are too heavily dependent on uh, a single employer or a single industry. Uh, but once you know, I don't think it's super complicated. Like there are basically sort of three things to look at. Population growth, you want it to be positive and healthy enough positive that it's not going to turn negative anytime soon. You want to have a large enough MSA that the economy is diversified, right? And you don't want the submarket to be too dependent on one employer or one industry, and good schools. And if you kind of like put those things together, you can find an asset that that is in a market that has those characteristics.
Mm-hmm.
You're basically good to go. All else equal. I mean, then you get into like where you are in the market cycle and the price and all that kind of stuff. But basically, if you've got those elements and you're buying it right for a decent price, then you're kind of doing as good as you can do.
Awesome. Well, thank you for clarifying that, and that I hope that breaks it down for people that population growth is something that you should actively be looking for. You mentioned earlier that we were talking about the ups and the downs in market cycles, and you brought up some points as to what would indicate an up cycle versus a down cycle. But can you elaborate a little bit more on that? Like, if I was an investor and I'm looking at today's climate, are we in a down cycle, are we in an up cycle? What is telling you where we're at?
Well, there's sort of like a normal cycle, and then there's where we are now, which I think
Good
are
point.
really, really different. But I think for a normal cycle, uh, you're going to start to see, for a down cycle, you're going to start to see cap rate decompression, which means you're going to start seeing cap rates rising, right? And the way that you're going to know that this is happening, I mean, no one's going to come to you and say, "Hey, cap rates are rising," but you're going to see stuff like properties just lingering on the market longer, right?
Mm,
You're going to see you're going to see the blast from brokers coming a second time and a third time, right? You see things like call for offers deadlines getting extended. You see you see some occasionally you'll see a price cut even, and you'll also see one of the subtle tells is you start to see uh, assets being marketed with an asking price as opposed to be determined by the market. And those things are going to tell you that you're in more of a buy, like the buyers are gaining strength in the market over sellers. That last one is the reason that is important is because of the psychology of the market. And I'm not sure if brokers, I don't think brokers are really doing this consciously, but I think subconsciously they are. What happens is when the market starts to decline, sellers have the expectations of getting the prices that they were getting at the peak, and that's where they've anchored themselves psychologically to those prices. They've already
sure.
spent the money in their heads. The problem is that the market has turned, and they're not really willing to accept reality yet. So what happens is that the brokers try to anchor the buyers to that high price by setting an asking price, basically trying to like prevent the lowball offers from being too low, because someone will look at the price and say, okay, I'll offer 10% off that, and so they're trying to set it high enough, but they want to anchor you to something that you're going to make
Right.
your discounted offer off of. At the opposite end of the cycle, what you see is, and you can tell the market is changing when you start seeing those asking price packages disappear and being replaced by to be determined by the market, because that's when there are enough bidders in the market that the sellers and the brokers are worried about accidentally capping the price by putting an asking price on it and anchoring people downward, right? So they want to remove that anchor, but in a buyer's market, they want to set the anchor to try to keep you from lowballing too much below that. So those are things that you'll see in the shift, psychologically from a seller's to a buyer's market.
So, Jonathan, something that Kevin and I both found really fascinating is um, a few months ago, you and your team liquidated a large portion of your multifamily assets. Can you talk a little bit about that? Maybe share the reasoning behind that?
we actually sold everything last year.
Okay.
And the reason for that was I'd actually been out of the market in terms of buying for a couple of years because I thought that things were just overpriced. And unlike some of the bigger players who have, teams of underwriters who can look through hundreds of deals to try to find one, and make offer after offer after offer to try to find one that actually fits their criteria. I just didn't have that capacity. So I was just really out. I mean, just seeing the prices of stuff that both on and off market were just way more than I was prepared to pay. And so that was one thing. So I'd been out in terms of acquisitions for a while and just managing the portfolio that I owned. What I started seeing in the market was sort of a number of things. One was just there was a steady drumbeat of people asking me to sell my properties, right? Just brokers calling saying, would you be open to offers? The other thing was that there, a couple of years ago, there were some kind of clouds on the horizon in terms of the economy. People were talking about the possibility of a recession. And the properties I owned were all C properties. And we were having, in what was supposedly the best economy in the history of the country, we were having trouble at some properties collecting rents because that tenant base doesn't have a lot of wherewithal. I mean, they're stretched thin. Even if on paper they can pay the rent in terms of like what their income is and what the rent is, they've also got car loans, they've got credit card bills, they've got just expenses of life, right? And we had enough problems collecting rent from those people in a strong economy that I really started to worry about, well, what happens if the economy is not this strong? What does it look like then? And it wasn't a pretty picture, particularly given that we were in a market that was very manufacturing dependent. And even thinking about where the economy could go, I mean, I wasn't expecting a repeat of the great financial crisis, but in those markets during the great financial crisis, just before I got in, vacancies went to over 10%. I mean, they were up as high as 18%.
Wow.
So I just was like, this is not a pretty picture. And even though I don't expect it to get that bad, it's going to be worse than it is now. So given that I had, these were all deals that I had that it was all investor money, I started to realize that the risk of not selling was starting to get higher than the risk of selling, right? There might be some additional small amount of upside, and I'm sure I left some money on the table by selling, then as opposed to a year later or whatever, but it really wasn't worth taking the risk. The risk was missing the opportunity to sell, and then A, not being able to get that price again, potentially for years, and B, worse, having the performance of the properties drop to the point where you couldn't make distributions, or even worse because of what the impact on the C-class tenant would be in a recession. So I made the decision to sell. I sort of was open to the decision to sell. Then sort of what finally happened though was that I got an offer, or I got a broker called me and asked me if I would sell. And I just, it's just one of these things, like on this particular day, I had just had enough of brokers calling me and asking me to sell. So I threw out a number that was designed to make them say, that's ridiculous, like, Jonathan, you're nuts. And instead of them saying, Jonathan, you're nuts, they said, we'll see what our clients have to say. They called me back the next day and said, our clients will pay that. So I thought, okay, well, clearly it is the time to sell then, because that wasn't a number based on reality. It was just based on like what, the number that I picked to try to make you go away. So that's, we wound up retrading a little bit, but still, it was the number that we wound up at was good enough that I was very happy with what we did, and the investors were quite happy. So that's what was behind the decision. I thought, you don't make money unless you sell, right? At the end of the day.
Right.
So it was time to sell.
Note to self: don't lowball when someone's asking you how. Wait, just throw out a high number, see what happens.
Right.
Well, Jonathan, when things were happening, right? You're looking at the signs of what could be a potential crash, and you prepared for it. If the crash didn't happen, you kind of look quote unquote crazy, right? But because things have happened, you seem like a smarter guy than others.
Than I actually am, right?
Your words, not mine. But
No, I mean,
ultimately, what I wanted to ask
no,
is, what
yeah.
signs were you seeing that's saying, hey, something is going to happen?
Well, it wasn't so much that I thought like something is going to happen. It was just that I felt like the market was set up so that if something did happen, it wouldn't be pretty, right?
I see what you're
So
saying.
it's not so much that like I saw telltale signs that other people missed, nothing like that. It was just, the market had gone on so long. Things were so overpriced. There was so much complacency in the market. We were at the point where people literally were once again, it'd been long enough that there were people who were lots of players in the market, not a few, but I mean, many, many, many players in the market who didn't even remember the great financial crisis and who had only been investing in an up market. And they had all convinced themselves that this is a no lose proposition. And for me, that was quite frightening, right? And I thought that when the market reaches that state, then you just run into like a euphoric melt up, and that's when you're just ripe for something to happen. Now, what I thought the something would be, maybe we'd have a war, maybe there would be. I was concerned about a corporate debt crisis. I think
Right.
that's something that was and still is kind of a possibility. But things like that, I thought that's where the pain was going to come. That was going to cause the economy to go off the wheels or to go off the tracks. But I obviously didn't. There wasn't any particular thing that I was seeing that made me anxious. It was just more the idea that we're just kind of setting ourselves up for disaster, and so something is going to happen. I just don't know what.
Yeah. Yeah. A lot of people were saying something's going to happen. And I don't think anybody could have seen something like a pandemic coming. But Jonathan, what are your plans now? So you liquidated your portfolio, and what do you plan to do next?
Yeah, so I mean, I continue to build my investor base, and I do a lot of social media stuff to do that. So it's really building the investor base in anticipation of what I think now is pretty likely to end up as a correction. And I also run a big coaching membership group, which trying to pass on what wisdom I've got to other people who are starting out, and get them ready as well. I think that there's going to be a pretty substantial opportunity coming up. Whether it's as big as the great financial crisis, I don't know, but I think it's certainly going to be a better environment to buy in 12 months time than it was 6 months ago. So I think there's going to be some distress. I think there's going to be just some softening of the market, and that's what I'm trying to get ready for.
Nice.
Definitely can see that. So how would you, with the opportunities potentially piling up, what would you advise somebody that's, or how would you coach them, if you will? They're trying to figure out what they should do.
Well, I guess it depends on what they want to do. Are they looking to just buy something themselves, or are they looking to learn how to be a syndicator? So just refine the question a little bit.
So yeah, I guess let's go with a syndicator. Let's start with that. And what would you advise a syndicator to do? Then we'll talk about more an everyday investor kind of thing.
Yeah. So if somebody is looking to learn how to, wants to syndicate deals, I think so. They should recognize that it's going to be easier to find deals and harder to find money when the opportunities come, and the time for them to start looking for the money is right now, and you're not looking for money per se. You're not going out and getting commitments, but you need to be going out and making those relationships with investors, making those relationships with brokers, and building that network that you can then call into action when the opportunities come. Making the relationships with other syndicators who maybe if you lack experience, or you lack some skill set, or you lack some investors, where if you're in a position where you can find deals, you can partner with them to help you raise the money. But it's not going to happen. I think people have to realize that this is being a syndicator is not it doesn't happen overnight. Like you can't snap your fingers and do it. You also, you can't, no matter how good a deal you find, you can't raise the money unless you built the network ahead of time. So now is the time to be building that network, and frankly, educating potential investors on the fact that an opportunity is going to come. And I also think another thing that's important is when you're having conversations with people, you have to kind of understand the psychology of the non-real estate expert. If there is a correction, the non-real estate expert is going to say stuff like, well, we've just had this big crash. Why would you invest in real estate right now? You have to prepare those people to understand that you want to invest after the crash, not before the crash, right? After the crash is the best time to invest. That's when you're going to make the most money. So you want to be having these conversations with people ahead of time so that they're ready for these opportunities and feeling a little bit greedy about them before they happen, rather than feeling scared because all the people around them are saying, "Oh, real estate, that's dangerous. It just had a crash. Lost all this money." So you want to be basically building that machine now to get ready for when the opportunities present themselves.
Yeah, that's great advice. And as a syndicator, I can tell you, and someone who's fairly new to it, I can tell you that what you said fully resonates with me. Yeah, it's not easy. It takes time, and you certainly have to build your base, and just kind of takes time to develop that. It's hard. And a lot of the people who listen to our show aren't necessarily interested in being that active of an investor. Um, to be a syndicator who takes down large apartment buildings. Some may, but a lot of our investors are really interested in passive investing, and they like being the people who invest in those big deals and get great returns on their money. So, what advice might you have for them?
Yeah, I would say to those people that don't, when the news you're hearing is bad, that should be whetting your appetite as an investor, because the bad news is when the bargains are there. You may well have heard this. This is just something I live by, but like Warren Buffett always says, be scared when others are greedy, and be greedy when others are scared. And there's just so much wisdom in that. It sounds really trite, but it's just so true. If everyone around you is talking about what a bad idea it is to invest in real estate, that's probably the best time possible to invest in real estate. So, if you're a passive LP, I think a lot of passive LPs, frankly, they're jumping into the market at the wrong time. Like the retail investor, whatever the investment class is, the retail investor always gets slaughtered. And the reason for that is because the retail investor isn't privy to the early knowledge, but they're only privy to the bad news. And they're watching like what CNN is talking about. And CNN will always talk about whatever the bad news is. And then, so they'll be out of the market at the best time. Then what happens is they see the early movers start to make money, and they go, okay, this is a good idea, but they're still nervous. And they wait until they start seeing like their friends investing. And then, so basically they sort of slowly get pulled in, but by the time they're pulled in, it's like towards the end of the cycle, and they're just sort of investing at the worst time and setting up to lose money. And then when they lose money, they're like, see, they were right. I shouldn't have invested. So they're usually getting in at the wrong time. Usually they're getting in when they're hearing everybody else doing it. Like it's the following of crowds. You have to be contrarian. If everybody around you is talking about real estate, you should be saying, maybe now is not the best time. And when everybody around you is saying what a terrible thing real estate is, that's the time where you should really be investing. So if you're talking about, investing with the two of you, if you're an investor, I'm speaking to your guys' investors right now, when these guys come to you, in 12 months and say, we've got a deal for you, you guys should be jumping all over it rather than saying, I don't know, there was just a crash, I'm really anxious. Because that's the time when you want to be investing.
I like that.
That's
So
awesome.
that contrarian plays well into your personality. I definitely can see that.
Yeah,
Um,
totally.
yeah, that's and as a retail investor, there's just something you mentioned that you're not getting the first hits of the information. So that's another thing you can do in preparation is start figuring out where you can get more information, where you can get more educated. Because even if the right opportunity presents itself and you're still looking at the wrong spots to learn, you won't see it as an opportunity. So I think
Yeah,
that's important to point out.
absolutely. And I'd say, like, as a passive investor, be building relationships with guys like Kevin and Adam, right? Who are more privy to that early information because they're in the business, right? This is what they're focused on. Unlike the passive LPs who are they're not really focused on it. They've got their lives and their jobs and their families and their other concerns. So they're only really conscious of these opportunities when they're hearing it from all directions. But guys like you and me, this is what they do for a living, they're privy, they're studying the markets a lot more. So get to know people who are doing this full time, because they're going to be telling you when you have to think about it a lot. They're going to tell you when the opportunities are there. Just make sure you know those guys ahead of time.
Right.
So that's the key.
Yeah, and we're really big proponents of education. We really like to see people educating themselves so they understand what they're looking at. We can help explain it a little further or go into a little more detail, but we really want people to know enough to understand if it's a good deal for them, and be able to tell that. And you made a comment earlier about the news people listen to, and often it's the wrong news. I couldn't agree more. Are there any sources or resources or places to get information that you might recommend to people who aren't sure where to start?
Well, first of all, what I'll say is ignore everything that you see on, like, general consumption financial news, right?
Yeah.
Because so whether it's Yahoo Finance, whatever it is, all that stuff that's easy to find, that pops up on Facebook for you without you searching for it, that that stuff is usually, it's the worst information to look for, because it's usually written by journalists who have little to no financial understanding, and little to no actual, like, practical experience, right? So oftentimes what you'll see, and this drives me nuts, is like these top 10 lists, like the top 10 places to invest in 2020, and they're usually built on some kind of arbitrary ranking system that these journalists just pulled out of thin air, because they're not trying to provide real advice. They're just trying to get clickbait, right? So
Right.
they want clicks on their article. So listicles are great, and then so they come up with some criteria, and the criteria is always out of date by the time you read the article, right? It's always backward looking anyway. So ignore that stuff completely. I would look instead at stuff uh, like Seeking Alpha, which is written by, unfortunately, there's not a lot of real estate information there, but there's a lot of discussion about the economy and markets in general. And, and look, honestly, you won't get a clear picture from reading it, because there's a lot of people arguing both sides of, is it going up, is it going down? But it's all really well reasoned. There's just a lot of people who really, it's written by people who are in the business of, like, making money on investing. So that's a site that I look at pretty much every day, just to see what people are thinking and saying. There are some industry press stuff that you can look at, but I tend to see that stuff as being fairly bullish all the time. I honestly, like, really distrust anything that's written by the brokerage industry, because no matter what the news is, they'll spin it to why you should be buying, because that's how they make money. So the National Association of Realtors, like, don't believe a word they say. Those guys are just, they're famous for being wrong, and famous for just trying to basically spin whatever news there is into a reason to buy. It's always time to buy as far as they're concerned. So I don't know, getting good information as a passive investor is a little bit difficult, but seeking alpha just on markets in general and where the economy is going in general, and what's really happening with employment, things like that. There's a lot of discussion there, which I think is high quality. So I'd recommend that site.
We'll definitely put that in the show notes. One thing, jump in a little bit backwards here, is you were talking about you hadn't bought anything in a couple of years before you sold everything. One characteristic for super successful investors is this ability to also say no. Can you walk us through, and this could apply to past investors too, when to say no to an opportunity? Walk us through when you were looking at buying something, you're like, I'm not going to do it.
Well, for me, and at the point where I really stepped back from the market, it was because the numbers just didn't make sense. And the only way that numbers make sense or don't make sense to you is if you actually have like a standard that's in place. So for me, the standard was I wanted to be able to pay investors an 8% preferred return, and then also pay myself on top of that.
Right.
And that becomes very difficult when cap rates for C properties are at 6, and for B properties are at 5. And what you see happening though is people start to stretch or loosen their standards in order to get deals done. And they all talk about being conservative investors and being disciplined, but if they're changing their criteria, then they're not, right? They're not conservative investors. Or you can actually apply conservative underwriting principles in a way that's not conservative. And this happens at the top of the market all the time. So people will say, I'm a conservative investor because I underwrite my deals according to this, and this, standard underwriting procedure. But the problem is the standard underwriting procedure is, the rules of thumb are designed for the average point in the market cycle, right? So, you should be going off them, being more or less conservative from those underwriting principles, depending on where you are in the market cycle. If you just apply them mechanically, you can, be a conservative underwriter and be wildly aggressive. And this, I think, is what was happening to a lot of people at the top of the market, who were justifying paying, 5 caps for deals that have historically traded at 8 caps or higher. And, and there was, well, the Fed, well, the this, well, the that, well, millennials don't want to own apartments or don't want to own homes, or they can't own homes, or, tons and tons of reasons. But those are all after the fact rationalizations to justify an essentially emotional decision to buy because they wanted to buy. So if you don't have standards that you stick to, then you have no standards, right? If you loosen your standards, you have no standards. And I don't really understand how you can be a conservative investor and vary your standards. So I'll point to somebody who is a lot more experienced than I am. But my friend Brian Burke, I'm sure you guys know him from Bigger Pockets and stuff, and he's owned thousands of units over his career. Brian is at the point where he's still doing deals, but he's doing one deal a year, and looking at hundreds of deals to find that deal, because he's not deviating from his standards. But it's extremely difficult for him to do deals because he's not deviating. Meanwhile, there are guys out there who were buying thousands of units a year, right, who weren't around in the last crash.
Right.
And Brian got burned in the last crash. He learned his lesson. These guys have never been through that. And I don't know what's going to happen to those guys, but I suspect the reason they're able to buy so many deals is because they've just used all kinds of justifications for modifying their standards as the market got higher and higher. And that only works if the market goes higher and higher forever. At some point, there's a reckoning, and that's what I think a lot of people don't like to think about. And honestly, why I got a lot of flack for selling my properties and for saying that we were at the top, and people didn't want to hear it. But you know, we'll
Yeah.
see who's right in another year. So
Time will tell.
yeah.
So, Jonathan, we'd like to switch gears a little bit. Kevin and I are huge proponents of networking. We think it's super valuable. And we were wondering if you would tell us about the Harvard Real Estate Alumni Organization.
Oh, well, so actually I need to take that off my bio because I'm not on the board anymore.
Okay.
Yeah, I was on the board of that for years. I mean, in terms of networking, like that was actually not the best place to network for me because that was highly institutional. It was really a lot of people who were, not doing their own thing, but were working for big institutions.
Okay.
So, but in terms of I'm happy to talk about networking because it is really important.
Sure.
Yeah,
I
absolutely.
So one of the things I always tell my students is you have to think about what your objective is when you're thinking about where you should be networking. And so if your objective is to meet other syndicators because you want to have like people to fall back on if you can't raise money yourself, you want to have JV partners, then real estate conferences are a great place to meet those people. Maybe your local real estate investment club, maybe not. But you do want to have those people. You want to know who's who in the business, and it's good to have those connections. So those real estate events can be good for that. But if you want to meet investors, if you want to find passive investors, going to real estate events, going to your local real estate meetups is probably not the best use of your time, because those events are organized by people who also are looking for the investors, and they're the ones who have the mojo at those events because they're the organizer. You're just someone who attended, right? You're just another putz who's there, right? Unless you already have a presence in the field, right? And people already want to meet you. But if you're going there and trying to build a business, it's very hard to get anybody to pay attention to you in those kinds of events. And the local real estate meetup, 9 out of 10 people at those meetups are house flippers or wholesalers. They're not looking to be passive investors in multifamily. So what do you do? The objective is you want to find rooms of wealthy people where you're the only real estate guy there. So what do those rooms look like? Well, they look like alumni groups. Maybe not the Harvard Real Estate. That was a professional, more of like a professional alumni, for professionals. But I mean, alumni groups, right? Or church groups, or country clubs, or corporate boards, or the local chamber of commerce, or BNI, or name it. There's tons of groups out there where you're gonna there are people who are affluent professionals who have the wherewithal to invest, maybe looking for investments, and they don't have access because they don't know any syndicators. That's the room you want to be in. You want to be the only real estate guy in the room. So you want, when somebody asks one of those guys, hey, I heard about how you can invest in these private deals and apartments. Like, how do you do that? And they're like, oh, I know this guy. I know this guy, Kevin. I know this guy, Adam, right? That's where you want to be, in that room. And those rooms, you also have to be consistent though. You can't just show up once and expect anything to happen. You got to join the group. You got to join the group, and you got to show up time and time again. The other thing is, groups like that are always looking for speakers, and people are always afraid because they're like, I'm not an expert. What do I know? Why would anybody believe me? The thing you have to remember is, if you know a little bit, you are the expert to somebody who knows nothing, right? So you probably know enough to go put together a presentation about how to invest passively in a real estate deal, or what to look for in a real estate deal, or pick a topic. Like, it's all of interest to people who are looking at it. And then you're the expert. You're the expert. You really are an expert for them, and you have that authority, as the expert. So that's what you want to do. Don't waste your time going to meetups and stuff like that, unless you want to meet the people who are going to be at the meetup. The other thing is that, for some people, and I'm actually one of those people, in-person networking is not really that much fun. Like, I don't really enjoy it all that much. I don't mind being a speaker. Like, I tell people, I'm more comfortable speaking to an audience of 1,000 people than speaking to one person at a time, right?
Interesting.
So, because I'm actually introverted despite all of my social media presence, right? But that's the reason I pursued social media, is because it's a lot more comfortable for me to speak to a big audience than it is to go and like network one-on-one. I'd rather, so if you can figure out a platform, whether it's a podcast or a Facebook group or a blog or whatever it is, where you can, establish authority and build an audience of people who are looking for what you're doing, and then you can attract those people to you. That's also a way to start getting investors. And maybe when you start out, you have to do a combination of the two. But at some point, you get to a point where you can kind of pick which one you like, doing the in-person stuff, doing the online stuff, or audience building. But you have to do one or the other, and you have to do them. You have to do them consistently.
That's great.
Amazing advice. And you covered the whole spectrum of people that are super extroverted and introverted. So we love that.
Fantastic.
Now, we would be the tech guys who invest if we didn't ask about tech. So right now we're recording this July 2020 in the midst of the COVID-19 pandemic. What piece of technology has made your life easier throughout this whole thing?
Well, probably Zoom, to be honest with you. I mean, Zoom has been kind of a lifesaver during all of this. And it's not like it sprang up out of nowhere, but it's one of those things that was already in place, and now we all realize how important it is, and we probably won't go back now that we're all doing video conferencing and stuff. But interestingly enough, since you guys are the tech guys who invest, so I actually, for my coaching group, I do a quarterly mastermind event, and I also allow people who are I sell tickets for people who are not members of the group. But we just did one this past Saturday, and rather than just focus on multifamily specifically, I decided I would do something a little more grandiose and just a little bit different for a change, and talk about the future of real estate as a result of COVID. And I interviewed people from like 6 different food groups in real estate, from like office, multifamily, self-storage, hotels, mobile home parks, co-working, and inevitably the conversation turned to tech in every single one of those conversations, because every single one of those asset classes had some kind of tech solution to COVID. And it was all stuff that, either they knew about before, but they hadn't used, or they were starting to use it, but COVID has pushed it really over the edge to where now it's really going to be like a best practice of the industry. So that's, I'll just throw it out there. Like, you guys want those videos, reach out to me. I can tell you how to get them. It'll cost money, but it's not a ridiculous amount of money. Or you can join my group, and all those videos are part of the membership. So if you're interested in that, just reach out, and I'll let you know how to do it.
That's great. All right, Jonathan, thanks so much. It's been really great having you on the show. We appreciate all of the wise advice you've shared, and it's really been great having you on the show. Can you tell our listeners how to find you, maybe if they're interested in your coaching program or things like that, how they can get in touch?
So there's 2 ways to get in touch. One, if you're interested in learning more about the investment side of the business, please go to twobridgesmanagement.com. That's Two Bridges spelled out, and MGMT for management.com. There's an investor form you can fill out to start the conversation. If you would like to learn more about the coaching program, the best way to do that is to go to multifamilylaunchpad.org, and you will find an ultimate checklist to doing your first 100-unit deal with other people's money and getting paid to do it, which walks you through it's like an 11-page long checklist that walks you through every step of the entire syndication process. That will get you on my email list. You'll see how to join the program if you join that. And then one last thing is, I have a big Facebook group. We just crossed 10,000 members, called Multifamily Investment Community. That's completely free. It's pitch free, spam free, everything other than networking and advice free. So just hit that up, and And just as long as you agree not to spam the group, you're in. So
Yeah, excellent. I'm in
check it
there.
out.
All right, Jonathan, thanks again so much. It's been great having you on the show.
Thank you so much for having me.